Good afternoon, everyone, and thank you for joining us today for another one of our Great West webinars. Today we are pleased to have Cassandra Whitelaw from MMP joining us today. Cassandra is a manager with MMP's tax group in Regina. Specializing in indirect tax, Cassandra works with businesses and not-for-profit organizations, helping them to stay compliant with federal and provincial sales tax legislation. During this hour, Cassandra will help us to have a stronger understanding of how Canada's Goods and Services Tax, or GST as we know it, really works. Thank you, Cassandra, for joining us today, and please feel free to start whenever you're ready.
Thank you for the introduction. So, as Josie said, today I'm here to talk about Canada's Goods and Services Tax. So this presentation is just meant to be kind of a brief overview of the issues with GST and things you need to watch out for. Obviously, there's quite a bit of legislation surrounding GST, so this will just kind of cover everything at a high level. So as I'm going through the presentation, if you guys have any questions, please feel free to just type them into the chat box. And then at the end of the presentation, I'll go through all the questions that have come in. Also, if you're having trouble hearing me, just let me know, and I'll see what I can do to fix that. So to start, we'll talk about just kind of an introduction to the GST and HST system. Then we'll get into some responsibilities that businesses have relating to the GST. Then we'll get into the forms and filing as well as accounting for GST. And then we'll wrap up the presentation with common deficiencies and errors that we see that can cause you issues when you're dealing with GST. So to start with, I'll talk a little bit about what GST is. We'll talk about the different tax rates, the types of supplies, and finally input tax credits. So Goods and Services Tax, or GST, is a transactional tax. It's a 5% or a 0% tax on the supply of most goods and services in Canada. Harmonized Sales Tax, or HST, follows the rules for GST fairly closely. The main difference is the tax rate. So HST is comprised of both the 5% federal component as well as a provincial component. So in Ontario, the provincial component is 8%, which works out to a HST rate of 13% in the province. For Nova Scotia, New Brunswick, Newfoundland and Labrador, and Prince Edward Island, these provinces all have a 10% provincial component, in addition to the 5% provincial component working out to a 15% tax rate. So these HST provinces don't have their own provincial sales tax. Instead, they receive the provincial component of the HST. Both GST and HST are administered by the federal government. So because this presentation, I think most everybody, the majority of people are in Saskatchewan. So we will focus kind of on the GST. So there'll be several instances where I may just reference GST, but the same rules will apply to HST. Another thing to consider about carrying on business in Saskatchewan, as well as the majority of the other non-HST provinces, is they have their own provincial sales taxes. And these provincial sales taxes sometimes have different rules than the GST. So you need to be cognizant of the rules and such around the provincial sales taxes, but we won't get into those here. So when you're just trying to determine whether or not GST or HST should be charged, you're going to look at the type of supplies that you have. So a supply is a provision of property or service in any manner, and this will include sales, transfers, barter transactions, exchanges, licenses, rentals, leases, gifts, and dispositions. And so for GST and HST, the tax rate that is applied is determined based on both the place of supply, so where the supply is occurring, as well as the type of goods or services that are being provided. So for each different type of supply, there's different rules in determining where it occurs. So the main categories of this would be a supply of goods, a lease of goods, a supply of real property, a supply of services, and a supply of intangible property. So these rules are quite complex, so we'll just go through them in a pretty high level here in the interest of time, but just for you guys to kind of keep in mind when you're determining what tax to charge. In the case of a supply of goods, goods are generally deemed to be supplied either where the supplier makes the goods available or where the goods are delivered. So things that you want to keep in mind when determining the place of supply are where the recipient takes possession of the goods, as well as who has the legal responsibility for the goods. Something to note here is that the concept of delivery is not based upon who is responsible for the freight charges. It is based on the delivery regardless of who's paying for the shipping. So there's two ways to determine where the supply of a lease of goods is occurring, and this will be based on the duration of the lease. So if your lease is for less than 3 months, it's going to be based on where the supplier makes the property available, and it's a one-time determination. And so basically, if you were to rent a car in Ontario for a week and you took it all the way across the country, went to Alberta and back, went through a bunch of provinces, because the origin point of the lease was in Ontario, you'll be paying tax rates at Ontario's rates. In situations where leases are greater than 3 months, it'll be based on where the property is ordinarily located, and it's looked at, it's redetermined on each lease interval. So if you had a machine that you were renting for a 6-month lease term and you had it in Ontario for most of the first part of the lease term, you'd be taxed at Ontario rates. If when the lease term renewed for another 6 months, you'd move the property to Alberta, then you would switch the rate of tax you were paying based on where the property was ordinarily located for that time of the lease. The supply of real property is going to be based on where the actual real property is situated. There are special rules regarding who has to collect and report the GST on the sale of real property, and I'll get into those a little bit later in the presentation. So when dealing with the supply of services, it gets quite tricky. There's 4 general rules and then over 18 exceptions. So in the interest of time, we won't get into these. If you are supplying services in multiple provinces or you have customers that you're supplying services to in a different province, I would advise taking a close look at these rules to make sure that you can determine where exactly the service is deemed to be occurring. Generally speaking, it will look at the contracting address, so the province where the recipient is being billed for the place of supply, but as I mentioned, there are a lot of rules around this, so unfortunately it's not quite that simple. So in addition to where the supply is occurring, there's also different classifications of supplies. So the 2 main classifications of supplies are taxable and exempt supplies. Taxable supplies are those supplies that will attract GST. There are certain supplies that will be taxed at a rate of 0%. These are known as zero-rated supplies, and essentially what these mean is you charge tax at a rate of 0%. So the customer doesn't actually pay any GST, but it enables you to recover any GST that you've paid on inputs for those supplies as an input tax credit. The majority of goods that you're gonna, or services that you're gonna see are gonna be taxable supplies taxed at the GST rate of 5% or the HST rate of 13% or 15%, depending on which province you're in. Exempt supplies are those supplies that which do not attract GST, and you won't be able to claim back any GST that you've paid relating to the inputs for those supplies. So as I mentioned, most goods and services will be taxed at a rate of 5%, 13%, or 15%, depending on where you are. So some examples of these would be commercial property rentals, sales and leases of automobiles, clothing sales, professional fees, so fees for accountants and lawyers, etc. Soft drinks, potato chips, and other types of snacks, gasoline, hotel accommodations, the majority of advertising services, franchise fees, commercial real property and newly constructed residential real property, car repairs, and things like that. So I mentioned zero-rated supplies. So these supplies will be taxed at 0%. meaning that your customer doesn't pay GST, but you can claim any GST that you've paid on the inputs. Probably the most common example of this is basic groceries. And so if you've ever looked at your grocery bill, you'll notice that things like your milk and your bread won't have GST applied, but if you've bought something else like a pair of socks, then they will apply GST. And that's because basic groceries are zero rated. Agricultural products are also zero rated, as well as prescription drugs and medical devices. When you're exporting goods or services out of Canada, there are some items that if you were providing them in Canada, they would be attracting GST. But because you're exporting them, the tax rate will be 0% on those. And this is just to ensure that Canadian businesses can remain competitive in the international market. It allows their customers not to have to pay the sales tax, but it does allow them to recover the sales tax that they've paid. Finally, exempt supplies, so the ones that do not attract GST. Some common examples of these would be used residential housing. So something interesting to note about this is if you buy a new home from a builder, you actually will wind up having to pay GST on that house. However, if you are purchasing a house that somebody else has lived in for their residence and you're now going to be using it for your residence, then it is exempt for GST. Another very common example of an exempt supply would be long-term residential accommodation. So the threshold for this is 30 days. And so basically what this means is if you're renting a hotel room, for example, you will have to pay GST on that. But if you were renting your house to live in for longer than 30 days, then that would be exempt. Most health, medical, and dental services are also exempt from GST, but it's important to note that any services performed for cosmetic purposes will be taxable. A couple other examples of exempt goods and services would be insurance policies, music lessons, and the majority of services provided by financial institutions. So that would be your banks, your credit unions, and things like that. So I've mentioned input tax credits a couple times here. The abbreviation for this is ITC. And ITCs basically allow a business to recover any GST or HST paid on the purchases and expenses incurred relating to their commercial activities. And the purpose of this is basically just to ensure that the end user is the only one paying GST. So it's not a cascading tax. It doesn't get paid over and over. It just gets paid by the very end user. There are many rules around input tax credits. There's limitations, and the other important thing to keep in mind is that you can only claim an ITC to the extent that the purchases and expenses are for the consumption, use, or supply in your commercial activities. So there's some general rules for ITCs. These will apply to operating expenses and real property. Capital property has different rules. So basically, if you are using the item that you've purchased for 90% or more for the use, consumption, or supply relating to your commercial activities, then you can claim back a full ITC. So you can get back all of the GST you paid on that item. Conversely, if you're using the item 10% or less in the use, supply, or consumption relating to your commercial activities, you aren't eligible to claim an ITC, and so the GST will be a cost for you. If the item is being used between 11 and 89% in commercial activities, then you can claim a partial ITC, and basically you can claim the percentage of GST related to the commercial activities. Now that being said, there are some limitations on certain types of expenses that you can claim input tax credits on. The biggest one is meals and entertainment, and so this basically follows the income tax rules. For income tax purposes, you can generally only deduct 50% of the before tax expense. So similarly for GST, you can only claim 50% of the GST or HST paid on the cost of these meals and entertainment. There are a couple of different ways you can report this. The first way, which tends to be the easiest, is to just claim 50% of the GST paid on the meals and entertainment right up front, only include 50% of it in your GST general ledger. The other option for those people that are filing monthly or quarterly is that they can claim 100% of the input tax credit as they go along during the year. And then in the next GST return in the following year, they have to make an adjustment. So although you can use this method, it does get a little bit more complicated and involves more tracking. So generally it's simpler to just include 50%. Again, similar to the income tax rules, there are limitations on input tax credits for home office expenses. So these home office expenses are any expenses associated with the home, such as utilities or property taxes, that you're claiming a portion of as a deduction for your income taxes. So keep in mind this is expenses related to your workspace. So it doesn't include items like office supplies and that kind of thing. Those follow the regular GST rules. So in order to be eligible to claim an ITC on home office expenses, your workplace either must be your principal place of business, or it must be used 90% or more to earn income from your business, and it must be used on a regular and continuous basis for meeting your clients or customers. So basically, you need to have a dedicated workspace in your home. It can't just be an office that you use for other things and that sort of thing. So just keep in mind if you're looking at claiming the ITCs on these type of expenses that there are limitations to who can claim them. As I mentioned, there are separate rules for capital property purchases. So these will be your capital assets such as computers or furniture. The general rule for these is if they're used more than 50% in commercial activities, then you can claim a full ITC for these expenses. If they're used less than 50%, you aren't eligible to claim the input tax credit, and there aren't any prorating rules like there are for the operating expenses. The other thing about capital property is there are quite a few specific rules that exist for things like passenger vehicles, real property, and certain other types of capital property. So these are, I'll touch on these a little bit, but they are pretty complex, so I won't go into them in a lot of detail, just in the interest of time. For passenger vehicles, once again, GST follows the income tax treatment. So if you have a passenger vehicle that's been included in class 10.1 for income tax purposes, then you will have a limited ability to claim an input tax credit. So even if the vehicle cost $48,000 and you've paid 5% GST on the full $48,000, your input tax credit will be limited to that 5% GST multiplied by $30,000. So you won't be able to you won't be able to claim all of the GST that you paid. You're limited up to the $30,000 threshold. For real property, if you're selling GST or if you're selling real property to a GST or HST registrant, then it's the purchaser, not the supplier, that's responsible for self-assessing the GST. And they do so on the GST return for the period in which they purchased the property. The advantage of this system is that it allows them to also claim an input tax credit for that real property, provided that it is used exclusively in commercial activities. And so basically what this does is it mitigates cash flow issues because you've got the GST reported and then you've got the ITC claimed and it nets to zero. And so basically it's just to mitigate cash flow rather than you having to pay the GST up front and then claim the ITC on the next return. You can just deal with it all in one return. And so one other thing is if you've become a GST registrant, you are able to claim input tax credits for some of the property that you have on hand at that time. So for operating items such as prepaid expenses, where the expense has been paid for but it hasn't actually been incurred, then you can claim an input tax credit for that property. This will be limited to expenses that haven't been incurred yet. So if you paid somebody to fix your plumbing and they fixed the plumbing and it's done, then you can't claim the ITC for that. The other thing is for capital personal property, if you're going to be using it primarily or more than 50% in commercial activities, you can claim an ITC, and this will be based on what's called the basic tax content of that item. And so generally speaking, the basic tax content will be the lower of the fair market value of the item at that time and the amount that you actually paid for it. So this basically allows you to claim the input tax credit but not make money on it, kind of thing. There are also some ITCs that you can't ever claim. So there are some GST that you're going to have as an expense that you won't be able to recover. So in addition to the capital property limitations that I was just talking about, you also cannot claim an ITC if you are providing, if you're buying or importing the items to provide exempt goods and services. There won't be an input tax credit available for that. And just like income tax, any membership fees or dues that you pay to a club whose main purpose is to provide recreation, dining, or sporting facilities, you can't claim those unless, of course, you're purchasing them to resupply them. But we don't see that very often. All right, so now that we kind of know where GST is charged and where you can claim it back, businesses have responsibilities regarding GST. So the primary responsibility of the business is that if they are required to be collecting the GST, they are collecting and remitting the GST on all their sales. So there's several components to this. The business number, actual registration requirements, you are required to inform your customers of certain things. And then we'll get into if you want to cancel your GST registration. We'll also discuss record retention and filing of the GST forms. Oops. So the business number is essentially an identification number used by the CRA to identify your business. This is similar to a social insurance number for individuals. Generally, if you're incorporating a business in Saskatchewan, Information Services Corporation will issue you a business number automatically. But if your business doesn't have a business number already, you will receive one when you register for GST or HST. It's really important to keep in mind that if Information Services Corporation has issued you a business number, this doesn't mean that you're registered for your GST or your payroll or anything like that. You have to set those up separately. So the business number has two parts. It's got the actual 9-digit number, which is the business identifier, and then it has an account identifier, which is generally an R followed by a letter, followed by 4 numbers. And so, for example, the GST, HST accounts are RT accounts. Your RC accounts will be for corporate income taxes, RP is payroll, and RM is import-export. And then after that, you can, in certain situations, have multiple program accounts. And so then after the RT or whichever letter, it's followed by 0001. If you sign up for certain situations, you can get multiple program accounts. So that would be RT0002 and so on. So in terms of registration, if you are providing taxable goods and services in Canada and you don't meet the small supplier thresholds, you're required to be registered. If you provide exempt goods or services, you won't be required to be registered, and you probably don't want to register because you won't be able to claim any of your input tax credits anyway. So you'd basically just be incurring a filing obligation for no benefit. So what is a small supplier? A small supplier is a sole proprietorship, a partnership, or corporation with total taxable revenues of the business and its associated businesses are $30,000 or less in the last 4 consecutive calendar quarters or in a single calendar quarter. Your total taxable revenues are going to be your worldwide sales of goods and services, which are subject to GST. This does include your zero-rated supplies, but does not include your exempt supplies. It does not include goodwill, financial services, or sales of capital property. The threshold for public services bodies such as charities, nonprofits, and universities is $50,000 or less, so they do get a bit of a higher threshold. Something really important to keep in mind is this isn't just the revenues of a single business, it's the revenues of that business and any businesses that are associated with it. So you generally look to income tax, and there are some additional rules for GST to determine if you're associated. So if you do own multiple companies, this is something that you want to watch out for. And so then if you are a small supplier, you can choose to register voluntarily if you'd like. The primary advantage to doing this is that it allows you to claim back any GST that you've paid as an input tax credit, providing it meets the requirements. So if you do register voluntarily, you have to charge GST or HST, depending. But the advantage is that you can claim input tax credits. If you do register voluntarily, you have to remain registered for at least 1 year before you can cancel your registration. So how do you go about registering? There's several ways that you can register. It can be done on the phone, it can be done in person, by mail, by fax, or online. By mail or fax, you can submit Form RC1, which is Request for a Business Number. This is the form that you fill out even if you've already got a business number. If you already have a business number, you only need to fill out certain sections of the form. In any other case, when you're registering by speaking to an agent, then the agent's basically going to ask you all of the information that's contained on this form. So this includes things such as the business identification, the structure of the business, the major business activities, the estimated annual sales, and the reporting period, which I'll get to in the next slide. For corporations, if you don't already have a business number, you'll also need to provide your certificate of incorporation. So the reporting period is basically how frequently you need to file your GST returns. You need to specify this when you register. The CRA does have default reporting periods, which it bases on the total annual taxable sales of the associated group. You can also select an optional reporting period, which will allow you to report your GST more frequently. And if you've chosen a reporting period and you decide later that you don't like that reporting period for whatever reason, you can make an election to change your reporting period to another reporting period that you're eligible for by using Form GST 20. So the default assigned reporting periods that the CRA has is when your sales and of those of you and your associates are $1.5 million or less, you're automatically assigned an annual reporting period, but you can elect to file more frequently, so monthly or quarterly. When the sales are between $1.5 and $6 million, the assigned reporting period is quarterly, but you can elect to file more frequently, which is monthly. And if your sales are more than $6 million, then you're automatically assigned a monthly reporting period and you can't file any more frequently than that. Generally, the CRA will recommend annual filing. The advantage to filing more frequently is you have access to your input tax credits sooner, but the disadvantage of that is that you have to file more GST returns. So you kind of have to make the call as to whether getting the money quicker is worth the additional reporting. So when you're charging GST to your customers, you have to tell them about it. So for any tackle sales and services except for zero-rated supplies, the supplier needs to indicate that GST or HST is included in the price, or they need to show the sale price and the total amount of sales tax charged. As well, there's certain information that needs to be included on invoices for customers. The level of detail is based on the amount of the sale. All sales, no matter how big or little they are, need to have your business name, the invoice date, and the total amount paid or payable. For sales between $30 and $150, as well as the other three things, you also have to include an indication of the GST charged or that the amount includes GST. You need to put what rate of tax you are charging, and you need to include your business number. For sales of $150 or more, you need to have all of those items, as well as the purchaser's name or trading name, a brief description of the goods or services, and the terms of payment. So generally speaking, if you have accounting software that's that you prepare your invoices on, my recommendation would just be to put all of the information on it. Then you don't have to worry about trying to figure out what needs to be on which invoice. It's just all there. For retail businesses, this is obviously a little bit trickier because you're not going to get the purchaser's name of everybody that walks into your store. So then you can kind of decrease the reporting, provided that you still meet the minimum requirements. But generally, if all your invoices look the same, I would just include all of the information. This is really important both to document what you have charged for GST if the CRA ever asks, And it's also really important because your customers are going to need this information so they can claim their input tax credits. So you can cancel your GST registration. There's several reasons you might need to do this. So if you've shut down your business, or if you've sold the particular part of your business making taxable supplies. If you've registered as a small supplier, you've been a small supplier for at least a year and you're still not required to be registered, you can elect to cancel your registration. Or if you stop making taxable sales. So if you want to cancel your GST registration, you can call the CRA, but probably the easiest way to do it is to complete Form RC 145, which is a request to close business number accounts. Something to keep in mind about canceling your registration is when you cancel your GST registration, there is what's called a deemed disposition of retained assets. And what this means is it basically means that any assets that are still left in the company at the time you cancel your registration, you're basically deemed to have sold the assets to yourself at fair market value and charge the GST on those. So you'll have to pay GST at the time of deregistering. But of course, because you're no longer registered, you can't claim an ITC for it. So depending on what kind of assets you have, there could be a fairly significant GST cost when you cancel your registration. So in terms of record retention, this is really crucial when you're dealing with anything, be it income tax, GST, anything with the Canada Revenue Agency. For GST specifically, you're required to keep any business records relating to the GST or HST for 6 years from the end of the year to which they relate. So this basically means that at all times you're going to have 7 years of records on hand. You're going to have the prior 6 years as well as the current year. The CRA can ask you to keep these records for longer, and conversely, you can make a written request to the CRA to destroy your records before the 6-year period, but you do need to get their approval before you destroy them early. The other thing is the CRA can audit your records at any time, and if your documentation isn't complete, then they can deny you input tax credits, they can assess notional GST and all kinds of things. So you really want to make sure that your books and records are clean and complete. So now that we've gone through all that, we'll go through the actual kind of administrative portion of it, which is the forms and filings. So we'll talk about calculating GST, how to deal with credit notes, accounting for GST, the filing process, including due dates and installment payments, and then penalties and interest as well. So GST is calculated using what's called the net tax method. So basically what you do is you take any GST or HST that you've invoiced on your taxable sales of goods and services, and from that you deduct all your input tax credits. So that's any GST that you've paid that you're eligible to claim an input tax credit for. So if you've collected or it's become payable more than you have paid out, you will owe the CRA money when you file your return. Conversely, if you have paid more GST than you've taken in, the CRA will issue you a refund. Obviously, it's never quite that straightforward, so there will be certain adjustments required when you're calculating your net taxes. One common one would be if you've incurred a bad debt. So when you've got a credit note or a return or something like that, the way you want to deal with this is to basically issue a credit note which shows you crediting the related GST, at which point then you can claim it back, which will reduce your net taxes in the period that the credit note is issued. It's important to always have written documentation of this so that if the CRA ever asks, you can support it. So obviously, with all this stuff going on and all these moving parts, it's pretty crucial to maintain a good accounting system that you can track both the GST or HST charged on your sales, as well as any GST or HST paid or owed on your purchases. So there are 2 ways you can do this. Generally, the most common way is just to track your GST and HST on individual purchases and sales. There is something called the quick method, which is available for small businesses where the total taxable sales of the entire associated group are $400,000 or less, including GST, in any 4 consecutive fiscal quarters over the last 5. And so when you're using the quick method, you basically collect your tax as normal, but then when you're going to prepare your GST return, you take your total tax included taxable supplies and multiply it by a specified prescribed remittance rate. And so basically what this means is that you can't claim ITCs because the ITCs are supposed to be worked into that rate. There are certain businesses that can't use the quick method. So these would be accountants, bookkeepers, financial consultants, lawyers, actuaries, listed financial institutions, municipalities, and charities. So generally, like I said, it's kind of easier usually to track the GST and HST on each individual transaction, but the quick method is available for certain suppliers. So because there is so much to track, I would highly recommend using an accounting software of some type. The majority of the accounting programs out there will track your GST for you, and they can generate reports for you to assist you with the preparation of your GST returns. And so this just makes the whole process a lot easier and quicker, and involves a lot less manual effort. So when you actually go to file your return, you'll be completing either Form GST 34, which is a personalized GST return, or if you don't receive that return from the CRA, then you need to fill out Form GST 62. The GST return and any amounts owing must be filed and remitted by the due date, so I'll get into due dates on the next slide. There are 3 ways you can file your return. The first way is to mail your return and your remittance to the address that is shown on the return. You can also take your return and your remittance to any participating financial institution, or you can file your return and make your payments electronically. So you can do this either CRA has a system called GST NetFile, and it also has the CRA My Account, so you can file your return electronically through either one of these services. Personally, I like the electronic way. It's quicker and you get your confirmation right away, and it's just a little bit easier, but it's completely personal preference how you'd like to file. So the due dates are a little bit different depending on your reporting period. If you're filing your returns monthly or quarterly, the GST return and the payment return will both be due 1 month after the end of the reporting period. If you're a sole proprietorship with a December 31st year end, your GST return will be due on June 15th of the following year, but you need to keep in mind that the actual payment is due by April 30th of the following year. So the payment's actually due before your GST return is, and they will apply penalties and interest on anything paid after April 30th. If you're an annual filer for anything other than a sole proprietorship, both your GST return and your payment will be due 3 months after the end of the fiscal year. With annual filers, sometimes the CRA will require installment payments. So these will be required if the total in the previous year was $3,000 or more. Installments are quarterly, and they're basically calculated as 1/4 of the previous year's net tax. So by the time you've paid all 4 of your installment payments, you'll have paid whatever your net tax was in the previous year. You do have the option of making installments on an estimate of the current year's tax, but this can be really tricky, and you want to be careful with it, because if you estimate less than the amount you actually owe at the end of the year, they'll apply interest and penalties on the shortfall of each quarterly payment. So if you're off on your estimate, you could wind up paying interest and penalties if your installment payments weren't high enough. So there's Form GST 58 is the personalized version of the installment payments. Generally, the CRA will send this to businesses. I think. So just make sure that you're getting your installment payments in on time, even if the CRA didn't send you something. A final thing to note about payments to the CRA is that they're not considered received until they're actually in the CRA's hand. So with some things, the postmark date counts as the date that the submission was received, but not in this case. So the postmark date is not considered the date received. It doesn't get considered received until it's actually in the CRA's hand. Also, if you need to make a payment of $50,000 or more, you can't make that payment directly to the CRA. You must remit it through a financial institution. And so now the not fun part is the penalties and interest. So the CRA will charge penalties and interest on late remittances of net taxes owing. late or insufficient installment payments, or any other outstanding GST or HST amounts that you need to remit. So the interest is calculated as the taxes owing multiplied by a prescribed rate of interest. The CRA updates this interest rate on a fairly regular basis, and you can go online to find the current rate for the quarter that you're looking at. For the third quarter of 2018, it's 6%. There's also penalties, and the formula for penalties basically works out to a late filing penalty of 4% of the taxes owing plus any interest. The other thing to keep in mind is that penalties and interest are compounded daily, so they can add up fairly quickly. So finally, we'll wrap up with just some common deficiencies we see people making when they're dealing with GST. So one of the big ones is if there's an associated group, oftentimes the wrong company will try and claim the ITC. So if you're dealing with multiple companies, just make sure that the one that's claiming the ITC is the one that's actually entitled for it. The other thing is if you're trying to claim an ITC and the vendor's GST number is not on the invoice, that ITC will be disallowed. They do give you the opportunity to go back to the supplier to get the GST number, but it's easier if you just make sure that any invoices that you're paying GST on have that vendor registration number. Also, oftentimes people will miss recording any GST or HST that they've paid on their imports. We see a lot of invoice processing errors, so these will be things such as GST being expensed as PST or PST being booked as GST and being claimed as an input tax credit, which obviously you can't do. There's a lot of issues with handling of invoice corrections. Sometimes the vendor should just be reissuing the invoice and they don't. Also, you need to keep in mind with input tax credits that they must be claimed within 4 years of you paying the tax. Another area that we're seeing the CRA really crack down on right now is elections. So sometimes companies will try and make elections when they're not meeting the criteria. They might miss the filing requirement and try and file the election late when that's not permitted. The other thing that the CRA is really starting to watch out for is the authorized signature on the account. So whoever's signing any elections that you might be making, you need to make sure that they are an authorized representative with the CRA. We also see a lot of issues with the handling of taxable sales of real property, just because the rules are very, very complex and people often make mistakes. And finally, there's something called a change in use, which I didn't get into in this presentation, but basically it applies when you've got an asset and you've changed the amount that you're using it in commercial activities. And so when that happens, you need to make a self-assessment on the GST, and we often see this get missed. All right, so looking at the questions, we have one question about the slides being available as a PDF. So I actually have to talk to my boss to make sure that I'm allowed to share the slides, but the webinar has been recorded. I don't think that there will be an issue with sharing the slides, so we can make arrangements for that after. And that looks like it's about it for questions. So does anybody else have anything that they know or that they're curious about? All right, so we got a question about when is the best time to register GST. So obviously, if you've met the registration requirements and you're to be registered by the CRA, you'll need to register at that point. Generally, if you're going to be making implies, I would register sooner than later, because that gives you the opportunity to claim any back that you, and so you don't lose those tax credits, because as soon as you're registered, credits for the GST. And so basically registering sooner does give you the ability to get access to those input tax credits. So we got another question about being registered for GST, and although you haven't actually started making sales. So basically, if you've registered for GST, to start reporting as soon as you register. So if they're all blank, even if you haven't paid any GST or collected any GST, you still need to file the return. You'll just file it with all 0 values. Yes, so it'll be based on the date you registered. So your first period will be from the date of registration to the end of the quarter. And if you haven't paid GST or collected GST, just file it all with zeros, and you can do it online, and it'll only take a couple of minutes. All right, so are there any other questions? See, somebody's typing. So when we just got the question, where could more be learned in relation to First Nations? So the CRA does have several guides up on their website. Or if you've got specific questions, you could always reach out to me. My contact information is included on the first slide. And either I can help you, or I can find somebody else in the Indirect Tax Department that deals more with First Nations stuff. But the CRA should have some guidance. We just got a question, do we file for GST while operating commercial business on reserve? So there are definitely different rules for the reporting of GST. Just give me 1 second to find it in my notes here. Actually, I'm having a bit of trouble finding it here off the top of my head. There are definitely special rules for GST when operating commercial businesses on reserve, but off the top of my head, I don't have that answer for you, but I can look into it and get back to you if you'd like. So we question about what if GST or HST has been collected by mistake before registration. So the CRA has a policy that if any tax has been collected in error, it does need to get remitted back to the CRA. All right, so looks like got a couple of minutes left here. So if anybody else has any questions, please feel free to ask them. Otherwise, I think we could probably wrap up and let you get on with your afternoons. I'd like to thank you all very much for coming to this presentation and for listening to me talk about GST. I appreciate you all attending and paying attention to me for this hour here.
All right, that looks like that's all the questions. Thank you so much, Cassandra, for joining us today and for taking time out of your busy day to share some insights about GST. I'm sure we all have learned quite a lot. I'd also like to say thank you for everyone who's able to join us today on this webinar. I just want to let you know that our next upcoming webinar is on July 17th, and it is all about e-commerce. So you can visit www.wesk.ca or check your Wesk emails for more information. Thank you, everybody, and have a great day.